What's up, everybody? Welcome to Heresy Financial. Today's video, we are just going to do a very quick coverage of what the yield curve is. Tonight at 8 p.m., if you're seeing this video today on the 15th, tonight at 8 p.m. on Facebook, we're doing a live stream, and then I'm going to take the recording from that and put it on on YouTube here later. That's going to be a much more in-depth discussion. But right now, we're going to do a brief overview on what the yield curve is. The yield curve is simply a graph or a chart that charts out the interest rate that the U.S. Treasuries are paying. And so if you imagine, let's see, I'm making sure I'm not doing this backwards here. If you imagine the graph like this, at the front end of the graph, you've got the shorter term Treasuries. And then at the other end of the graph, you've got the longer term Treasuries all the way out to 30 years or so. And so normally, if you're going to loan the government money, or anybody money for that matter, you want your interest rate to be higher for the longer that loan would be for. You want to be compensated for having your money locked up for a longer period of time. So if you've ever searched for a mortgage, your 30-year mortgage, you're going to get a worse interest rate than you would if you were to get a 20 or a 15-year mortgage. You're going to get a better interest rate. The bank is loaning you money for a shorter amount of time, and so they're not locking that capital up for such a long time, so they're willing to take a lower interest rate. That is the normal way that interest rates work. The longer the amount of time the loan would exist for, the higher the interest rate you'd expect to get from it. Well, the yield curve yesterday inverted. Now, what that means is that for the first time since I think it's 2009 was the last time or 2006 was the last time that we had an inversion in the yield curve. Investors and creditors were willing to take a lower interest rate on money they were loaning out on the longer debt versus the shorter debt. So it's backwards compared to what it normally is. Normally, the interest rates you would get on a longer loan are going to be higher. Right now, they're lower for the U.S. Treasuries, and specifically, it's the 10-year and the 2-year. So lower on the 10-year now than it is on the 2-year. That's the indicator that people are talking about when they talk about the yield curve. It's the 2-year versus the 10-year Treasury. And normally, the 10-year pays a higher interest rate. Now it's paying a lower interest rate than the 2-year. The key part of why this matters is that it's signaled a recession. For the last 9 recessions have been preceded by an inversion of the yield curve that just signals a flight to safety. Prices, supply and demand bidding up the price of those longer term Treasuries, which takes down the yield. So that is, in a nutshell, what the yield curve is. It's just when you loan the money, government, for some reason right now, a lot of investors or a lot of loaners, creditors to the government are willing to take a lower interest rate on the longer term debt just because there's a quote unquote flight to safety right now, which is why it's a good prediction of a recession. So that is the yield curve. It recently inverted, caused a little bit of a market drop yesterday. Later, I'll be posting the video from my Facebook live stream that will be taking place tonight. Connect with me on Facebook, and it'll be at 8 p.m. It is August 15th. It'll be at 8 p.m. Pacific time tonight on Facebook. Connect with me there to watch it live, and I'll post on YouTube after. Thanks so much for watching. Have a great day.